Awesome. Well, welcome to another edition of the Banzai Chronicles. I am here with Chris, Coop, Norwood. For those of you outside of the Men's Alliance world, it's Chris Norwood from Town Bank. Chris, would you say a little bit about yourself, introduce yourself, and give us a little background about who you are and why we're here today?
Thank you. Do you go by Banzai or do you go by Kevin?
Here we go by Banzai because it is the Banzai Chronicles.
It is the Banzai Chronicles, and I'm so excited to be here.
Yep.
Thank you for having me. I'm Chris Norwood, call sign Coop. I work for Town Bank Mortgage, have for the last this is my 16th year, 24th year in the business. So excited to be here, excited to talk about this topic with you, and hopefully we can put some good information down for some folks out there.
Outstanding. So for the folks that are, our goal today is really to talk about the basics of mortgages and then work our way up into the things that are going to be a little bit more complicated. So first, before we get into that, tell us a little bit about how you got into business, who you are, a little bit more of your professional and background, if you wouldn't care to share with us before we start diving deeper into things.
I've probably gotten the mortgage business in the most unorthodox way. I was a chef for 15 years, and my last food service gig was I was the food service director for SunTrust Mortgage Corporation, downtown Richmond.
Okay. I
ran all their corporate cafeterias. I ran the daily, anything from a coffee break to a full-on, China dinner plate meal for the executives. I did that for 5 years, and at the end of my contract was beat out, and so I was moving on. And the CFO of the CEO of the mortgage business for SunTrust sent his executive assistant down, and she says, "We have a job for you if you want it." And I'm like, "What are you talking about?" She said, "Mortgage loan officer." I'm thinking badge and a gun right away. Mm-hmm. Mm-hmm. So I set up a meeting. They told me a little bit about it, and I was like, "This sounds great." They said, "We've seen the way you've taken care of our employees for the last 5 years. We can teach you the mortgage business. You've got the customer service piece down." I'm like, "This is great. Okay, what's the salary?" They said, "Well, it's up to you. It's 100% commission." I'm like, "Oh boy."
Yeah, that "it's up to you" question.
It's up to you.
Is notorious in any type of commission industry. It's like, well, you can make whatever you want.
That's right. There's
no upside, but there's no upside cap.
Yeah,
but there's no downside support either. So when you were offered this, were there kids? Did you have kids?
Oh yeah. I had 2 young kids. Okay. My youngest was 5. I had 2 daughters at the time. So I called my wife and said, "Hey, this is what's going on." And she's like, "Oh, great. What's the salary?" I'm like, "I have no idea. 100% commission." She told me not to do it. Mm-hmm. She said, "Don't do it," because I was doing pretty good as a corporate chef.
Right.
And so anyway, of course, I went ahead and did it. Met with this guy who was he was our regional sales manager for SunTrust at the time, and he's sitting on the couch with the football coach. He pulled out the whiteboard. He's like, "Okay, what's your market?" I said, "Colonial Heights, Virginia." He said, "Okay, Colonial Heights, Virginia. Average loan amount is $110,000. What do you want to make a year?" I didn't know what to say. I said $100,000. Mm-hmm. He says, "Okay, to do $100,000, you need this many referrals a week. Mm-hmm. You need to make this many transitions into a real deal. You need to close this many deals." Mm-hmm. He goes, "Okay, now go get them. You need to close 200 loans a year." I'm like, "Okay, how do you do that?" So SunTrust was gracious enough to send us to basically like a finance boot camp. 3 weeks, hardcore, drinking from a fire hydrant. Mm-hmm. Here's your business cards, go get them.
Right,
and that's about the training you got. They didn't give you any guidelines for loans because they said they're going to change. So we're not going to give you anything written. So that was it.
But you ended up being, if I recall correctly, that you were a rookie of the year. Is that
my first year? My first year out of the gate, ended up doing 190 loans, just under 20 million in production, and I was scared to death. I was out there borrowing, scratching, stealing what I could get, just because I didn't want to starve.
Sure.
But yeah, that was my first introduction into my first year into the mortgage business was. Nominated by the Mortgage Originator magazine, number 38 in the country, or in the Mid-Atlantic region, for Rookie of the Year.
So I think we have the right guy here to help us with our topic.
It's been a good run, and I'm not going home smelling like food every night. So.
Right. Well, the other thing is, some of the things that you mentioned is also a topic some of the guys are interested in, and just there's a common theme amongst people that have been on the Men's Alliance podcast, our podcast, is the sink or swim mentality. Sometimes it's like when you get thrown into the deep end of the pool, you have no choice but to swim, and so things have a way of working themselves out because you have no choice but to succeed.
You better swim.
Before we get into that, tell me a little, just briefly, the little sidetrack. What was your mindset going in and dealing with the decision to take a no salary job, a commission job with wife, children? Again, you mentioned that your wife was somewhat opposed initially to doing that. Now, again, after it's worked out, it's like, oh, good, great. But in the beginning,
right,
those are tough conversations to have. How'd you work through the process? How'd you make the decision to do it?
Again, working at SunTrust was a pretty good gig. And just to clarify, that was my first wife, not the wife I have now. Before that was nights, weekends, holidays. That's your restaurant life. That's the chef life.
Right.
So the job I had before this job, I was missing so much of my kid's life. And honestly, I just got tired of the food service business. I loved cooking. It's a passion, and I've been refueled since I'm not doing it for a living anymore. But honestly, I was burnt a little bit. Day in, day out. It's just it's hard to keep consistent employees. Within my 5-year tenure at SunTrust, I probably hired and fired over 50 people. Just because of the turnover.
Right.
It's ridiculous. Then if not, you're dealing with temps. It was just, it wore on you. But with that being said, I just saw the opportunity where I knew if I worked hard, I knew if I took care of my clients, and I knew if I gave them my heart and soul, I knew it would work. I knew it would. At least I was going to give it a shot.
Yep. Sure. Yeah.
And then the potential to make the kind of money I've never made before.
Right.
So the flexibility and freedom in your schedule.
Right.
It's a blessing and a curse. I can work from anywhere.
Right.
The curse
or you could not work from anywhere.
Or, the blessing and the curse is the same. You work from anywhere and you end up working from anywhere.
Right.
My wife now, Julia, she's a real estate agent, so she gets it. But we went on our honeymoon with our computers. We worked during our honeymoon because that's the nature. She's a real estate agent. So that's the nature of our business. You don't really ever get a break from it.
Right.
If you're not available, they're going to mortgage.com, whatever. So if you miss the phone call, you don't pick up the phone, you don't answer the email back, they're going somewhere else.
Exactly right.
So availability, accessibility is big. People want right now.
Right. And the more internet-based they become, I want my answers, I want all my thing now. I don't want advice, I just want to click a button and just do this
That's
thing.
right. I want to
fill out this transaction.
I want to go buy this house right now.
Right.
Make it happen.
Right.
So with that being said, it was a shot well worth taking, and taking a stab at putting my work ethic. My dad had instilled in me at a very young age. I don't care what you do your best at it. Because I don't care if you're a trash man, do your best.
Right,
People are watching.
Yep.
So always had a good work ethic from him, thank goodness. And I knew I could apply that, and it was going to be up to me. And I knew I'm not going to fail myself. I'm not going to fail my kids. Not going to fail my family.
Right.
So scared to death, made every mistake in the book, but kept scooping up business and learning as you go.
Right.
And I call the mortgage business the big grocery store anyway. As soon as you have it figured out that it's changing.
Right.
Right. Yeah. So.
And I think that, the making every mistake is a good segue into this, because part of our goal, part of what we're trying to do at the Banzai Chronicles is our slogan is to shorten the learning curve for men doing life. And so as we start to get into the topics of mortgages, tell us a little bit about, let's start with the basics, and we're going to get a little bit deeper into that. So a lot of the questions, when I was in finance, I would probably, how to set up my portfolio was number one on the topics, but number two is what do they do with their mortgage in their house? So I spent a lot of time talking to people about that. As the folks are older, that become clients, because a lot of the financial advisors are working with older people that already have money, because the average 26-year-old is not coming in with a pile of money to invest. So we would still end up talking to people about that they're selling their house. Should they get a mortgage this late in their life, or getting ready to retire? But let's start at the beginning, and let's use our a younger audience as our target. So as they are doing the first-time home purchase, tell me a little bit about the FHA versus conventional versus what's available to a new guy coming out. What types of loan programs usually fit the younger person, let's call it a first-time buyer, for right now?
You know, that demographic has changed drastically. I don't know when you bought your first home. I was 24.
Many years ago.
Yeah, I was 24.
Yeah.
54 now. But what we're seeing...
1995.
I was 96.
Yeah.
So, but what we're seeing now is with this millennial generation is we're seeing them jump out of the nest a little later. So they're staying with mom and dad a little bit longer, maybe staying in the basement or got a room somewhere. But anyway, what we're seeing is we're seeing them jump out of the nest a little bit later, but we're seeing them buy bigger. So years ago, I would say over a decade ago, if not a little more, the average life of the loan was or a first home was 4 to 6 years. Then they're moving on, step up home or what have you. Now that's 7 to 11 years. And some of that's to do with demographics of, the housing prices increasing, so it's costing more to get into the home, so you stay longer. The rates and where they're at, so those there's a couple other things caveats that are causing these people to stay in houses more or longer. But part of it is this generation and when they're getting out of the nest. What I find surprising when I'm talking to my first time home buyers is how many times I ask, when have you done a budget? They don't very few have done a budget. So I think starting there and figuring out, hey, what can you afford? What's your monthly look like? What's your out-of-pocket look like the day of closing? These are the two pieces I need so I can start looking at how we're going to build this mortgage for you. The second thing is what's your credit score? That's huge, and that's going to dictate FHA or conventional. So some of it's down payment, some of it's income and things like that, but credit score is going to drive if I'm going to go conventional, if I'm going to go FHA. FHA is more lenient on credit score and more lenient on debt to income ratios. So if they have a little more debt or less income compared to what they have with their housing ratio, what they're going to have as far as their monthly payment, their monthly mortgage payment, including their taxes and insurance versus their income. FHA is a little bit lenient on that. Conventional there's some great products with conventional. Both of them have first-time home buyer caveats where we can use grant money with those. There's some second mortgages that can go along with those to take care of the down payment. So both loans have those features where we can couple those with first-time home buyer specific grants or second mortgages to cover that down payment. Again, the big difference with conventional and FHA is going to be the leniency on the credit score and debt to income ratio. We get a little bit more. Again,
does down payment come into that at all?
Sure.
FHA versus conventional. Tell me a little bit about that.
But first-time home buyer programs, I've got a 3% down conventional, 3.5% down FHA. But if they're within a certain income bracket, again, I can do a second mortgage to cover that down payment or couple it with a 2% grant. But they have to be within a certain income range.
Right.
And that's what most of the grant programs look at as the area median income. And it's different for every county.
So most people, when they hear conventional mortgage, they're thinking 20% down.
They do.
So tell me the difference between what the conventional that you're referring to and so again, most people when they're thinking FHA, they think that 3% down.
Yep.
Conventional loan is 20% down.
Yep.
Therefore, they all jump into the FHA bucket. And my first loan was an FHA loan.
Mine too.
And so tell me a little bit about the difference between a conventional that's 20% down and a conventional that isn't.
Yeah,
because I don't know that a lot of people even know that something like that exists.
Right. And I think you're right. They have this mindset. And a lot of it's their parents telling them, hey, you need 20% down to do conventional because that's what they did. That's what they had to do.
Right.
Things had changed. The agency, when I say the agencies, I'm talking Fannie Mae, Freddie Mac. They've adjusted their guidelines where even if you're not a first-time home buyer, we can go as little as 5% down. It's going to be coupled with mortgage insurance. Nobody likes to hear that word, but mortgage insurance is there on any loan, any conventional loan that does not have a 20% down payment. So anything less than a 20% down payment is going to have that mortgage insurance premium on there. And that's not for you. It's to protect the investor in case you wake up one day and say, you know what, we're out of here. We're going to go live in a van down by the river and not pay our mortgage anymore.
Right.
The investor's not losing their shirt. So they have that additional coverage. So it's there. And the cool thing about conventional on that aspect too, depending on credit score, you have 3 different options on how to pay that mortgage insurance. Traditionally monthly, which is the most expensive. You have a single premium that can be paid one time at closing, negotiate on the contract for the seller to pay it or pay it one time. Or you can roll it into the mortgage as long as it's not at 97%. If it's at least 5%, you have the room to roll it into the mortgage. So those are some neat options with folks that have the good credit score. Again, conventional is where I would lean. FHA, it's pretty cut and dry. Hey, it's 3.5% down. We do have the first-time home buyer aspect where we can couple it with a grant or a second mortgage, but they have an upfront mortgage insurance premium and a monthly mortgage insurance premium, period. That's how it is. It's 1.75% upfront of the sales price or the loan amount that's thrown into the loan, financed in, and then you have that monthly mortgage insurance premium on top of your principal and interest, taxes, and insurance.
Yep.
So where the leniency is, there's other safety nets for FHA, you know.
So one of the subjects, if I can jump in real quick, was that you brought up was credit score. And in listening to a lot of online financial people, there's a lot that discourage the use of credit cards under any means. It's the credit cards are never, no debt, none of that. So we're going to talk a little bit about leverage and mortgages later in this, but for right now, building your credit score. Yeah. When you're getting ready to show up and buy the house,
love it.
Is it better to never have had any credit at all when you show up, or is it better to have had a history of payments and a good credit history? Which one is, because again, you go through this all the time, is the screening process, because if you're at a 350 credit score, the answer is no. If you're at an 850, it's a yes typically. But But what gets you there? What does a young person need to pay attention to, or anyone need to pay attention to when it comes to their credit score and actually qualifying for the loan?
Then that's a great question, and it's one where I see a lot of misuse. Usually young college kids, that first thing they want to do is they get offered credit cards left and right, but they don't tell them how to use it. So credit cards are the best thing you can use to build your credit score because it's free will. Here's your credit card, here's an amount that you're approved for. You can go max it out on Amazon in 10 minutes. Or you can choose to use it responsibly.
Right.
So I tell folks, I don't care what the credit limit is. I care what your balance is. Okay? Because once you get over 50% of that limit with the balance, over that balance versus the limit, it starts to hurt you. Because the credit card thinks you're getting in trouble. It's like, okay, they're over 50% of the limit with the balance. What is going on here?
Right.
And typically you'll see, people max out and keep it there. Oh, I'm making the payments on time. Yeah, but you're maxed out.
Right.
And their score is every month getting tanked. Okay.
Yeah, let's spend an extra second focusing on that subject, because a lot of folks that have credit cards go, if I'm not over my limit, I don't have a problem.
Yeah.
No, that's absolutely not true.
50% or less.
Yeah.
And I use the credit card lots of times when I do credit rebuild.
Even when you're paying it on time. So if if I max out my credit card, or I'm close to maxing out my credit card, I'm making my monthly payments. I'm doing what they told me I should do.
That's right.
Or I'm supposed to do, at least. Yeah. Why is that a problem? Explain a little bit about why they think that's a threat, because I know exactly what you're talking about. But for a person who has not been through I'm using my credit card properly, or I think I am. Why is paying your bill on time a problem for these people?
Yeah. No, it's great, and again, there's no education that comes with a credit card. Just use it and pay it. But
Actually, that is an idea for another podcast.
It is. It is because I can tell you, it's a problem. Even folks, I've got clients that make $500,000 a year. Their credit is in the tank because they use these credit cards usually on a point system. They're gaining these points in cash back. And they're like, well, I pay it every month. I'm like, yeah, but you're maxing it out. He's like, but I pay it every month. I'm like, but the problem is when the last day of that credit card statement, when that creditor, let's say is Capital One, takes a snapshot of that account and it's maxed out, that's what he's sending to the credit bureaus to be graded. And it's the same thing with any credit card. So how your usage is so important that, again, you never want to go over 50%. I like to say 20, 25%. If you hold and maintain that type of balance, your credit score is going to hop. You're going to be, you're in a great zone. And what I tell people, I think, look, if you're going to max it out, know the last day of your monthly statement, make a payment or two before that. Go online and make a payment. Just so what's being reported to the credit bureau is not reflecting that you're running month to month on a maxed out card.
He's in the red.
Yeah. And guy makes hundreds of thousands of dollars a year, but it's the way he's managing his credit.
Yeah. So there's two things that are happening there. One is by maxing out the credit cards, of course, you're hurting your score, so you're lowering your ability to qualify for different programs in the mortgages. The other thing is the basic fundamental math of the credit card is that you are paying, most credit cards once you carry a balance, you're at 20-something%. Okay. And if you make one late payment, you're at 30-something%.
That's right.
It's really usury, in my opinion, at that level of interest. Yeah. But that's the absolute misuse of cards. But we've talked about use of credit to a degree a little bit on a prior podcast, and that some credit used properly is useful because in the financial world, gaining access to other people's money is, credit scores are a requirement. You've got to be on the grid somewhere.
That's right.
Unless you're dealing in Bitcoin and bars of gold and you don't need loans. The average human being has to deal in the real world, and credit scores and access to banking products is important.
That's right.
So when we are looking at qualifying for the first time, so if you're advising a new buyer, credit scores, use your credit scores properly. What do they look at a debt to income ratio? Kind of what do your numbers need to be to get a mortgage? So if we're trying to figure out, well, how much can I afford? Yeah. What's the easiest way for a new client to find out how much of a house can I Well, there's how much can I afford, max cap, and where should I go? Let's just start with the how much can I afford question.
Yeah. Can I go back real quick to the credit piece?
Sure.
Because there's something that I use quite a bit. When somebody comes to me and they have a subpar credit score, I use the credit card to get them where I want them to be. And I have a recipe that I use. And like I said, I tell them, look, even if you can't get a credit card, get a secured credit card where you pay Capital One $300 a month, $300, you have a $300 limit. Okay. I have a recipe that I send them. First purchase, $30 or $40. Wait 2 days, make a payment. If you spent $40 on Tuesday, on Thursday, send them $30, leave a $10 balance. Next Tuesday, a $30 purchase, Thursday, $30 payment. Do that once a week. Sounds ridiculous, but for the next 4 or 5 months, I've had soldiers come back from being on deployment, come back, pull their credit. It says NA. They have nothing because they haven't been in our credit system.
Right.
In 5 to 6 months, this guy's got over a 720 credit score because he did that.
Nice.
And this is something I use over and over again. The other thing I look at too, when I pull a credit score, in the mortgage business, here's a standard. If you have over a 760, 780 credit score, you're going to get the best rates and terms out there. Okay, so that's where you want to be. That or higher. So when I see somebody...
Not 550.
Not 550, not 601.
Right.
So if I see somebody in the mid 600s or the low 600s, I'll look at their credit. I'm like, okay, you got a couple accounts here. You got 2 or 3 credit cards. They're maxed out. do you have any resources where you can pay these down to a certain amount? And the cool thing that I love about Town Bank is Town Bank Mortgage, we have a credit enhancement department, and we're able to do a what if scenario. I'm able to take that person's credit report, run it through the what if scenario and say, okay, these 3 accounts, if I pay them down to a certain amount, it'll tell me what the rebound on the credit score will be. Mm-hmm. If they do that within a couple weeks, I can then take proof that they paid those accounts down, submit that to the credit bureaus, and get a new credit score within 5 to 7 days. So all within on the same credit report within the same 30 days, that can happen. Or I can set up a plan for them to do that organically over a period of time where they're going to continue to boost their score. But
I remember the program my wife and I first went through because I believe we had credit cards for nearly every store in the mall. We did the, hey, if it's going to give you a discount to sell,
10%.
I'm going to get 10% off the purchase. Yep. I bought probably every piece of furniture I own on some of those credit cards as well. So when we were qualifying for a mortgage, we had a lot of credit cards that were open. We didn't have any. Well, first, we had credit cards that had balances. So, yes, we had that.
Yep.
And then when we were looking at the credit score, we probably had 15 accounts that were open through the years that we just never closed. We didn't have anything on them, but we had open accounts. What's the problem with that?
They're stale. There's no activity. Mm-hmm. You get graded on how your usage is. Mm-hmm. So it can be. I have a credit card that I've had with Wells Fargo. I don't even bank with Wells Fargo, but I've had their credit card probably 25 years now. Mm-hmm. It's got a big limit, and I'll probably use it once a year. It doesn't give me any benefits, no points, no cash back, no nothing. Mm-hmm. But it's an old account that I've had for a long time that I have a large limit on. Depends on how, and again, I make it a point to use it once or twice a year just to keep it active, okay? Because what they'll do, the credit reports, the credit bureaus, they take all your credit accounts and they'll look at the balances versus the limits. So those accounts that you had open, yes, they would be stale after a certain amount of time and not really be working for you, but they're not hurting you either. They're just stale. But it could help you in the sense where they look at your total exposure, where you have your limits all together versus your balances all together. What's the ratio look like there? So it could be a benefit depending on how old they are. But if you have those old things lingering out there, I say, look, I tell people, have 1 or 2 credit cards, maybe 3 at the most that you use that you need. You need credit cards these days to make reservations in case of emergency, what have you. So if you have them, keep the ones you've had for the longest time. Ask for maybe a credit increase, right. A limit increase. That will help you. Yep. So those are some of the things. Now, it's kind of hit and miss, I think, on the stale accounts.
Yep. Because again, there are times where it's like, hey, I have access to credit. I've opened them. I paid them. There's no balance. Great. But then it's like, yeah, but you have access to all of this credit and you could use it if you want. Therefore, we view that as a threat and we're going to take points off. So in the history of financial planning, I've attended a number of credit workshops, score. There's no human alive that I've ever met that could explain how the credit scoring system actually works. To go, if you do this all the time, this always raises your number. Or if you do that all the time, it lowers your number. There is no perfect formula because I've gotten reports back on my credit score, but because I had an inquiry, just an inquiry.
Oh, yeah.
Now, we're not looking at me blowing up my credit or me misusing anything. I asked the bank about a loan. Yeah. And they said, no, that's terrible. And so you get points off. You haven't borrowed $1 yet, but the fact that you asked. Or you open up a second business credit card. You have an inquiry. It's negative. I'm like, I haven't even done anything yet. So on the credit scores, don't obsess about the getting it perfect, but it's again, I think the overall premise is use it smart, use your credit cards, pay them off, let them be there to help build your credit scores, not as a weapon of self-destruction.
Use it as a tool to build up, not as a weapon to destroy yourself.
Right.
The other thing I would say too, is, oh my goodness, I just had something to add to that, what you were saying.
The absence of
No,
knowledge.
no,
of how to
the
plan.
inquiries.
Oh,
the
yes.
inquiries.
Yeah.
Where they hit you hard, like when someone comes to me for a mortgage or to purchase a car, these are the two biggest purchases of your life. The credit bureaus recognize that you need to shop these things. Okay, you should shop these things. So what they allow you to do is get your credit pulled up to 15 times within a 30-day period. Now that's not 15 individual times. That's the 3 different credit bureaus 5 times. So you can go get your credit pulled 5 times within the same 30 days. I don't trust it. Typically I say 3 weeks, same 3 weeks. And every one of those creditors that pulled your credit should get the same scores. And it should only count as one hard hit if you do all your shopping within that 3-week period. So that it's where people get messed up in inquiries is when they get your credit pulled. It happens a lot when I see with couples, they go, it's this nice, pretty spring day. Let's go out and go car shopping, you know? So they go out and go car shopping. They talk to the sales guy. They get their credit pulled and they end up not buying anything. Another month and a half, 2 months go by. Let's go car shopping. That's where it starts to ding you. And I can see where those dings are. I've seen them. They're pretty big because you're getting it outside of that 30-day window. And they think, my gosh, these people are going around looking for credit every couple months. They ding your score. You know, that's their
Yes, there is a bizarre philosophy behind the credit score, and there is, like I said, I have not figured out the algorithm to
me either
to actually calculate.
Deal with
credit
it every
scores,
day,
but
and I have no idea.
Yep. So let's shift gears for a second, because another question I get a lot is, what's the difference? And again, this is basics of mortgages, but so we won't spend a lot of time on it. But it is a question I get a lot. What's the difference between a home equity line of credit and a loan?
Okay. Now, home equity loan or just a regular mortgage?
Home equity line of credit, a HELOC.
Yep. Versus a mortgage.
Versus a mortgage.
Okay. Home equity line of credit is typically done behind a mortgage as a second lien position. Not always. Now, if you own your home and my parents and their home, thank goodness they don't have a mortgage, but they wanted to put a home equity line of credit on the house just to be on the safe side. Okay. The home equity line of credit is almost like it's a line of credit. So it's like a credit card. You have a limit. You can borrow against that. If there's zero balance, you don't have to pay anything. Just like a credit card. Once you use it, you're paying on that balance. I don't want to go too far down that rabbit hole because there's a bunch of different caveats on a home equity line of credit. I don't do those personally. I have my bank branch manager do those. They're great tools. They are. And a lot of times during this time frame where a lot of my past clients are calling to maybe do a renovation or buy a second home or something like that, and they got one of those COVID rates that are like 3%. I'm like, if I do your mortgage, I'm gonna redo that one. You don't want me touching that rate. No, I don't want to touch that rate.
Right.
So I suggest, hey, why don't you keep that mortgage, do a home equity line of credit if you have the equity in your home, do a home equity line of credit, then you can do what you want with it. If it's a renovation to your home, you only pull out the money as you need it. You're paying on that interest-only payment, so you can pay extra if you want, or whatever you're going to use that money for. So the difference is mortgage. There's a lot more people involved. There's more cost. Everybody that's involved. I tell my clients, there's about 20 people involved in a mortgage process. Your realtor's number 1, and I'm number 2.
Right.
There's a whole line of people behind us.
Yep.
Title people, the attorneys, the courts, the appraiser, the termite inspector, all that stuff. So everybody's got to get paid. So there's more cost involved in a forward mortgage. There's more security with it because typically those rates are fixed.
Right.
So the home equity line of credit is tied to the prime rate. So the prime rate is going up and down constantly. It's been on its way down every time the Fed's been meeting over the last couple of years. That rate has been coming down. So I'm encouraging my folks, if you want to tap into your equity, use a home equity line of credit. It's the cheapest way. Town Bank, if it's under $250,000 line, we pay the closing cost. Doesn't cost you anything. So
Nice.
yeah, so
Nice.
It's a pretty. There's caveats to it. Now, when the Fed is getting nervous about inflation, those rates are going up.
Yep.
And the next day, your rate on that home equity line of credit is going up.
That's exactly right.
So,
So would you view that as a short-term money versus long-term money kind of play?
Well, it depends. I know at town, our terms are, it's a 35-year loan. You have 15 years to borrow against it. Use it, borrow against it, pay it down, borrow against it, pay it down, borrow against it. On the 16th year to the 35th year, the last 20 years, they freeze it if there's a balance, and you pay. They amortize it over the last 20 years. Mm-hmm. So
let me stop there.
Yeah.
So there's a lot of flexibility in the products, right?
Yes.
Because a typical HELOC, and let's go back, basic old school HELOC,
Yep.
is you open up an account with the bank, a line of credit. You could use that pretty much up to the next 10, used to be 10 years was the typical limit to open up a line of credit. If you didn't use any of the money, you don't owe any money. If you used the $50,000, you need to start making payments now.
Yep.
You had variable rate interests. So now HELOCs can be different terms. You can have fixed rates for fixed periods of time. There's a lot of nuances into the products. So when you're looking at finance, one of the things that I advise people is, because again, the game has changed so much just from the time I was younger. Mm-hmm. And then there was so many, I used a lot of basic loan products for myself. I was able to do, as I got older, your conventional loans, your second home loans, because a lot of those are going to be cheaper types of programs and least expensive. And so, there were a lot of things that I only used A, B, and C for myself in my financial world. It's all I needed. But now you have veterans that come back. There's VA loans, there's FHA loans, and then you can break down those into all these different little subsets. And then you have conventionals, which used to be 80-20, and now they could be 10. I did again years ago. It was an 80-10-10 loan.
Yeah, I love them.
Yeah. I had an 8% baseline mortgage, a 10% second note mortgage. Yeah. But the issue is that
those went away. Those went away.
Yeah, I know.
9 and 10.
I know.
But all the combo loans went away.
I was younger, but I wanted the house that we couldn't afford at the time, or my salary was growing a little bit back in that in that time. We didn't even have all the kids yet, but that was the game. I chose to do it. I probably wouldn't have done it again under the same circumstances, but I used that type of program. But the issue is the complexity in the products really is. Hopefully what we're trying to make clear is not everything is black and white and cut and dry. It's not necessarily A versus B versus C. The main concepts of home equity line of credit is just that. It's a line of credit against your house. Then you have a loan. It's usually for a fixed number and a fixed term, typically. When we are looking at loans for your typical buyer that's going after their first home, second home, there's a lot of options on the table. And so when they're going through the process, how do you figure out which program fits a buyer? And how does the buyer know it's the right program for themselves? Because a lot of them don't, because as we're talking now, there's a lot of things. Again, I was in finance, and I don't know anywhere near as much about mortgages as you do, but I've done a bunch of them, and I know enough about them. But I never knew about the VA program. I wasn't a veteran. VA loans didn't apply to me. It didn't matter. Yeah. After I did my first FHA loan, that no longer made a difference to me. Now it's like, okay, it's my second loan. So all the others, we sort of take these products off the table. And 50 products weren't even invented.
Yep.
Right? And so, so with that complexity in mind, how do you put somebody in the right spot, right That's product?
Good question.
And how can the client verify? Obviously, it's education and wisdom and knowing a little bit more about it. But how do they? Let's do your side first. How do you find the right?
That's a great question.
Put the right peg in the right hole.
No, it is. That is a great question. And honestly, it's about actually getting a little more personal with your clients. I ask my client, what's important to you? Why is owning a home important to you? And sometimes it's nobody in my family has ever owned a home. I'll be the first one, but it's getting to know your clients. And again, it almost takes me back to my chef days when I owned a catering company. Mm-hmm. And you met with a client. What kind of party do you want to have? Right. What kind of budget are you working with? Mm-hmm. So it boils down to just as a mortgage loan officer, being the type of mortgage loan officer that's going to ask questions that are going to peel back the onion a little bit. let's take a deep dive look. Once you have their credit, you have all their information on the application. There's still things that are important to them. There's still things that we can't see that we need to be sensitive to. And what I start with is, give me your monthly budget max, because I know I don't want to go above that, because you don't want to be uncomfortable. And where are you at? How much money do you have to work with on this mortgage? If it's zero, tell me zero. Then we can. That's how we're going to start building the blocks to figure out what the right mortgage is for you. Again, it's asking questions. Do you have current or prior military service? Is a VA loan right for you? Where are you looking to buy? If you're looking to buy out in the country a little bit, we have USDA loans. There's no down payment. It's 100% financing, and the rates are great, but they have to be in a rural area. And you'd be surprised. There's parts of the area I live in, Chesterfield. There's different parts of Chesterfield that are eligible for this product. Great program. But it's just to the point of diving deep, asking the questions, analyzing all the material that you have from their credit report, from their pay, their income information, their savings and checking and savings accounts, to see what they have to work with total, and then start building it from there. And then I urge them, because believe me, everybody's heard, because as soon as you tell someone you're buying a house, all your buddies are professionals. Oh man, I got this and I got that. So I invite, hey, have mom and dad call me, have your friends call me. I'd be happy to call and talk to them about what you're getting and why I chose this loan for you. Because I really do try and peel back the onion and figure out what the best loan is for my clients. Whether they're seasoned investors, buying another rental property, or a second home vacation property, or another primary residence. It doesn't matter. I want to try and make sure I've got the best loan going for them. And I have no problem if they shop it and look around at another place. But I can tell you that's the biggest thing, is just getting to know your clients a little better personally. Yep. And they'll reveal what's important to them. And then you have all the financial and the credit information. You can put those building blocks together, and you're going to come up with a mortgage that they'll be like, wow, should be happy with, unless they're just unrealistic. Right.
Right. I have a friend who's a real estate agent, and there was a meme that came out recently that says, Bob wants a house that's right near his office, which is downtown in the city, and Sally wants it by the beach with a lot of acreage, and they have a budget of $10,
Yeah.
And so it's an impossible, trick.
So he breeds salamanders.
Yeah. Yeah. So when I've used financing, either for my own personal home or investment properties, I've always used 30-year loans. Yep. For me, I want to borrow as much money as possible. I want to cash flow it. And cash flowing is, again, I'm able to use the income and the rental income in order to offset the mortgage and the expenses. So it means I'm making money on a regular basis is positive cash flow. So by using a 30-year mortgage, if they would have given me a 100-year mortgage, I would have taken it. Yep. It's the joke I make. I know the math really doesn't work out on that, but in jest, that's the concept. I want to borrow as much money as possible. When rates went down to 2.5, I was calling banks and I was like, loan me everything that you can. Whatever my cap would be, I want to borrow that much.
Exactly.
And so, but there is a counter argument to using longer term mortgages. So, and I'm not saying 15-year isn't right for someone. If you want to pay down your house and you want to get out from underneath that debt and you want to do it sooner, a 15-year mortgage works. What's your opinion on 30-year versus 15? When is it good? When is it bad? What do you recommend typically for a person?
That last piece you were talking about is about borrowing all the money you could. Dave Ramsey's rolling around just biting his nails at you right now.
Yeah, 100%. 100%.
But it's true.
Right.
If you can get money that cheap, use it.
Right.
Use it. Keep yourself liquid. But again, I'm sure you did all the analysis on that. Now,
because math is math at the end of the day. the math works.
And it's cheap. It's cheap
Right.
money.
And if, again, the apocalypse happens, it really doesn't matter what I did, because if money becomes nothing and the whole world goes to dust, then everything all of us know about money is now null and void.
That's right.
So everything you thought you did smart, well, you had it in the bank.
matter.
Well, that means you counted on FDIC to pay you back.
That's right.
And you didn't have more than the limits, and you didn't have money in the stock, and you didn't do this, and you didn't do this. So if the dollar goes to dust, everything that you own and think you have and you think you're protecting by not having any debt, it doesn't really matter anyway at that point.
Yeah.
So that's my theory on that.
I like the theory.
But going to 15 to 30, when is it appropriate? Just give me your general thoughts on 15 versus 30.
I've definitely got a thought on it, and the way I look at it is, 30-year is what I always kind of push people to, and we're not seeing that much of a rate break right now. Mm-hmm. There's not that much of a divide right now. 30-year fixed rates, conventional, are running right about 6.125. Okay. 5.75 for 15-year. We're not seeing that big, like a 1 point break like we did, 10, 15 years ago. There was usually a big difference between those two terms. I like a 30-year mortgage because life happens. Life is going to continue to happen.
Exactly.
Yeah. If you need to be regimented and you don't have enough self-control to make extra principal payments when you have the funds to do so, and you feel like you have to get this house paid off within 15 years, maybe a 15-year mortgage is right for you. That's going to keep you on track. But I hope nothing happens, because it's typically, when you chop the amortization from 360 months to 180, that payment's going to get affected, and it's pretty big. Mm-hmm. Now, you see a lot of movement when you make those monthly payments, but if you want to go on vacation or something happens dramatically, you have to pull extra cash from somewhere else to pay for something, or Christmas or birthday or a trip somewhere, you have that lower 30-year mortgage payment. There's no prepayment penalty on it typically. I've been in the business, this is 26 years. I think I've done one prepayment penalty loan. It's just not common. Right. They're out there. Right. They're out there, but typically there's no reason why you can't make extra principal payments if you have the means to. Mm-hmm. But God forbid something happens, or you need to put those funds somewhere else for that month, you're just responsible for that lower 30-year mortgage.
Right, and that 15-year payment is a fixed,
it don't move.
Non-negotiable payment.
It does
Nobody
not move.
cares that you got fired, you got laid off, etc.
Nope.
And you get more room in the budget with the 30-year. It's same thing. It's life happens. So for most mortals that are paying their house, and the house is typically one of the biggest bills, that and health insurance often are the cases where you're actually making the payments on your mortgage. Stuff goes wrong in your life. Things happen, and or things that are outside of your control where you need more money. The 30-year mortgage gives you the flexibility you can pay it off like it's a 15. You could literally do the math, and that's what, if I wanted to pay something off earlier, do the math and go, if I make this much extra principal payment, I can pay it off in whatever time frame I want.
Yep.
Which I have never done, except for my own personal home. The only thing I've paid off is my house. But I've never paid off. If I have a rental property, the second it goes up in value, I'm going to pull the cash back out of it. But
that's something too. I'll tell my clients, look, if you want to know how much to pay every month to pay it off in 25 years, 20 years, 15 years, 10 years, I'll tell you. Mm-hmm. That way you can have it at least in the back of your mind. The one payment extra per year. Sure. Is an easy one to do. That's about 7 years knocking off a 30-year mortgage. Some people divide that principal and interest payment over 12 months, divide it by 12, or they make just one extra payment a year.
But you can choose to do it.
That's your choice.
You can choose to do it.
That's right.
So before we get into leverage and investing and stuff, let's take a lighthearted sidetrack and go down.
Right.
Tell us about your worst client. Give us a story or two about who the worst people that you've had to deal with and why. And obviously no names, of course, but
wow.
Tell me a little bit about why you had to have had them.
Yeah, I do. I try and purge them from my memory. And we run across them. And after every closing, an automatic survey goes out to every client of mine. Mm-hmm. And there's just some that I was like, please don't send that survey to them. But, worst client, I would have to say That's a tough one, man. I have such good clients most of the time. I've been blessed that way.
So you've never gone home, told
there's-
your wife
there's-
about a problematic client that you had, and if so,
Yeah. Okay.
and if not, if you can't think of any, we'll move on.
I'll come back to it. I'll come back to
All
it.
right.
How about that?
Sure.
We'll try and
sure.
come back.
He's trying to think of a story that without divulging confidentiality.
It's kind of tough.
Yeah.
You know.
So when again in the talk about using loans for building wealth, the term is leverage, right? You're using other people's money to help create net worth wealth. And so I believe there is intelligent debt and then there's awful debt. Debt to buy depreciating things, again, it's your typical credit card. I bought car for, you're buying stuff that's not an asset. Your shirt isn't going to be more expensive 5 years from now. Your pants, your shoes, etc. None of that's going to be worth anything more. That's you're just spending money on stuff. So that kind of debt is negative debt. It's the toxic debt. It is the thing Dave Ramsey tells you to run from, and from which I agree with him wholeheartedly on that. Credit cards can be a cancer of someone's personal finance. I agree with that. I think they need to be used as the tools we discussed earlier. I use it paid off, and then I get bonus points. I build up my credit scores, and I get the benefits of that. But you need to have the cash and the self-discipline to make sure you pay it off.
That's right.
Because again, even with me, with my own credit cards from time to time is I either didn't set it up on auto pay or before auto pay was a thing. I forgot to pay the bill. Forgot. I didn't have the money in the account. You still get dinged.
Yep.
Right? Now, again, it doesn't hurt your credit, but if you're in, you get a penalty.
Yeah.
You get a penalty. If you're a couple days late,
Oh,
normally,
yeah.
not 60 days.
I thought you're talking
I'm not
36
90 days late. Yeah.
Yeah.
No, but again, if you just did something, oops, I just forgot.
Yeah.
It costs you money to do that. So if you need to have the discipline to knock that down. When it comes to buying assets, leverage in real estate is one of the ways of helping to build wealth. So tell us a little bit about some of your investor clients. How do they use it? Why mortgages? Why do people use leverage to build wealth?
Well,
give us the basic fundamentals.
I think you touched on it a little bit, especially like an investment property. Man, they want to get as much as they can, least amount down, least amount of money out of their own pocket into the whole deal, so they can keep their capital liquid, so they can maybe look at another property or any renovations that an investment property might have. They know that they're going to be able. They've done the math. Hey, I know I can charge this much rent, even if it's very close to break even. It's still somebody making the mortgage payment for them. It's building wealth every month.
Say that phrase again. It's someone making the...
It's someone making the mortgage payment for you.
Right.
It's building wealth. Even if you're not making a ton of cash back, but you're not having to make that mortgage payment out of your own savings account, someone else through rent is paying that for you. You're building wealth. Every month you're building equity. And on top of that, there's been very few years where we haven't seen an increase in real estate values. So it's a double growth in equity. You got the equity being paid down. You got the principal being paid down by the rent payment. Then you got the value going up just by the property getting more valuable. So your equity is growing almost twice as fast. So
Right.
real estate is always, in my book, it's a great investment. Very few times is it not a good investment.
Right. And so let's talk about that. For the times that it's not a good investment, the times where you've had temporary downturns in the real estate market, because again, in 04, 05, real estate prices started to come down. The vision or the mindset, I should say is probably a better word, that real estate can never go down in value is obviously not correct, and there are times where it does that.
Yeah.
What are the things that help protect an investor, that help them hold course, that help them not panic sell? So if I own a property, what are the things that I need to not sell the property? Or should, what kept good investors alive during the downturn, and why were some decimated?
I would say probably the most important thing, if you're going to get into real estate investment, reserves. And reserves is having extra payments in your bank account that you don't touch. It's there in case, God forbid, you need to evict somebody and they've destroyed your house and you're not going to have a renter in there while you're doing construction. Or it's just a soft market and it's taking a while to rent your property and you're having to make those payments. That's where I see the biggest dangers where folks don't have reserves. because anything can happen, and then you're exposing yourself.
And tenants don't treat your stuff like
you
it's
do.
their stuff.
That's right.
Right. It is again, having rentals, you cannot believe what people will do to furniture, walls, flooring. It's almost like it's intentional.
Yeah.
It's sometimes the damage is almost like someone's doing it on purpose.
Yeah.
And so it is a part of the game of that.
My wife and I had a rental property. It was the same circus and merry-go-round every 6 months to a year. New carpet, new paint, new flooring, just whatever.
Yep.
Oh, no smoking, no pets. There's pets and there's smoking. Yeah,
Yep.
They don't care. And
Right.
It is.
Right.
Now, at the end, if you can stomach that, because it's not easy being a landlord. Mm-hmm. So, but if you can stomach that in the long run, it's a great retirement plan. It really is.
Right. Yes. That is part of the business. The concept of people tearing up your stuff, you have to view it. It just isn't personal. It's not. It isn't your stuff. They're not doing it to you. Mm-hmm. It's just the way they live. It's just how they act, and it's just part of the cost of doing business. Again, it's Amazon has all these delivery trucks. You have to buy gas. It's part of it's an expense. There's a charge
and
to
all of them are beat up.
Yeah, right. And
they're all banged up.
Yeah, and so, but it's a cost of doing business, and you just have to factor that in. People will go in, they'll decorate their home with really nice furniture and all this nice stuff. And again, you should create a nice environment for your tenants. It's wonderful, but it isn't your furniture. It isn't your couch. It isn't. If they spill something on the couch, it's not your couch. It's not like they were a guest in your home.
That's right.
And it is part of the costs. So, as we get close to wrapping up, talk to me about the things again. If you were, there's two questions I have. One is in the mortgage process, what costs are typically negotiated most by clients? What should they pay attention to about the costs? And then second, what are the tips that you would give someone who needs to go get a loan for whatever reason?
Well, if you're coming in and a client is coming in with strong credit, good money, all that stuff, they typically what I encourage them, look at the credit. Look at the interest rate. Negotiate there first. I like to work with my clients. When I plug in, we don't get a rate sheet anymore like we used to. Here's 10 o'clock in the morning, all the rates are out. Here's your rate sheet. No, Everything these days is risk-based pricing, which means I put into the system that particular person's or couple, their particular situation, their credit score, their income, the type of home they're buying, their down payment, where they're buying, the zip code. Is it a attached property? Is it a condo? Is it a single family residence? All this stuff goes into the pricing engine, and it'll spit out rates. Mm-hmm. Those are their rates. So when people call them and say, "What's your rate today?" I'm like, I need to know a lot about you.
Who you are.
Yeah,
right,
exactly. I was like, I can't tell you that anymore because
there's the rate, and then there's your rate.
Exactly.
They don't necessarily match.
Much. That's
right.
Great. I'm going to use that.
Yep.
There's no rate. But anyway, so that is particular to their individual situation, and I like that because it's up to you. Mm-hmm. So with that being said, talk with your loan officer. If it's not me, talk with your loan officer about negotiating the rate. What's the best I can do? No harm in asking that question. Is there a possibility for me to negotiate a lower rate? Sure. I get 20 rates for each program. We can talk about rates that have no cost, rates that have credits, and rates that actually have costs that you can lower for the whole life of the loan. Mm-hmm. Let's do the math to see if it makes sense to do that.
So when someone...
That's a discount point.
When someone talks about it being free, how do they make free? What do they do to the loan to make? I know the answer.
Oh,
I want you to share.
Yeah.
When it's a free loan, there's no cost. There's no cost. We're a bank and a mortgage company, and we have all these employees, but we're going to give you a loan free.
Yeah.
How does that all work? How do they bury the cost? How do they get to say that?
I would say it's
basic.
a lot of it's hidden in rate, and the other part is all their third-party services are in-house, so they're able to curb.
So what do you mean when you say, just for the folks who might not know what you're talking about? The burying it in the rate. Tell me what that means.
Again, when I pull rates, I get 20 different rates. let's say the market rate today is 6.125 and has no cost whatsoever. But if I give you a 6.375 or 6.5% rate, not too much more than 6 and an eighth, a little higher, actually getting credit for that. You're getting a credit back because you're choosing an above market rate, so it's coming with a credit. Where
Right.
it was costing nothing before, now there's a credit. Those credits can help absorb the cost.
Right.
Okay. So I can do a no cost loan too. You might not like the rate,
Right.
but that's how you're absorbing some of that cost is through rate. Doing that, the investors who put out these mortgage rates are putting out rates, again, some that have credits, some that don't have any cost at all, and some that have cost. So those rates that have credits are typically higher than the market rate for that day.
Right. Right.
But we're getting that extra credit money to, sorry about hitting the mic. I keep doing it. It sounds like a big thud. So that's the other thing I would say is, these days, negotiate with your real estate agent. Sellers, there's new rules that came out last August that said that sellers don't have to pay buyers agent closing costs or buyers agent commissions anymore. Is it smart to do that? Probably not. I mean, it's been customary for decades now that sellers pay both sides of the commission on a sale. I have seen it a couple times in the last year where the buyer is paying for that. So therefore, when I'm doing a pre-approval, I have to make sure I account for that. Commission on a 3% on $300,000 is $9,000. This is an extra $9,000. I have to make sure they have to pay their real estate agent at the end. So that's been a little wonky. And the other thing you can look at as far as when you're looking to buy and you can save money is look at, do you need an attorney or can you use a title company? Title companies usually run a little bit lower cost than an attorney. Attorneys have a degree on the wall. Now, if you feel like this deal is a headache between you and the seller, you probably want to have an attorney in your corner. But if it's a fairly smooth deal, you can get by with a title company. You can probably save yourself a few $100s right there just by using a title company.
Awesome.
Sometimes we run specials where we'll pay for an appraisal. That's another $525 that you don't have to pay. So ask. Sometimes, hey, if you open a bank account with Town Bank when you're doing a mortgage, I'm going to give you a credit at closing just for opening up a checking account. There's little things like that.
It's ask.
It's ask. Yeah, ask.
Right.
So that would be something I would do is just ask if there's discounts. Ask if there's any way to save money. Regardless if it's your real estate agent, your loan officer, the attorney, title company, whoever it is, your insurance agent. Is there any way I can save a little more money? Well, we can adjust your deductible. Maybe your premium will be a little bit lower. Insurances, as you know, have gone through the roof over the last couple of years. And while I've been talking, I'm not going to give you my worst client, but what I'm going to do, I'm going to compromise. I'm going to give you my most embarrassing moment in the mortgage business.
Fair enough. That'll probably be even better than what I asked.
It is, man. It is. And so whenever you're ready for that.
Go, I am right now. Let's jump right into it. Let's put no hesitation on this.
All right. This is great. All right, man. So when I was at SunTrust, I was probably 7 years into the business. I was trying to figure out ways to increase my loan amounts because, again, I cut my teeth in the mortgage industry in Colonial Heights, Virginia. Average loan amount was $110,000. Not getting paid much on that. So I started construction, and I went down to the VCU Medical Center and started getting in touch with all the doctors that were graduating. So we offered doctor loans. Doctor loans were 100% financing, great rate, no mortgage insurance. Banks look at doctors as, okay, they don't look great right now coming out of college because they're student loans and they're just doing residency for 4 years and they're making $40,000, $50,000. But after that residency, they go from $50,000 to $200,000 in income. So the banks understand that. So they want to do these loans to create that relationship with the doctors. So I was doing a bunch of doctor loans. Yeah. And I had this doctor in my office with their child, young baby, and the wife. And years prior, I had an eye surgery where I had a detached retina. And I had to have an extreme surgery, and it's called a cerebral buckle, where it's a band around my eye. It was intense. I couldn't, they kept my eye dilated for 6 months, and I couldn't lift anything over 10 pounds, couldn't bend over below my heart, all this stuff. So as I'm doing the loan paperwork for his lovely wife, the baby, and the doctor sitting there, I said, so what's your specialty? Because most of the doctors are going into some sort of specialty. And I could have sworn he said retinal specialist. And I said, oh man, do I have something meaty to show you? And I start seeing his wife getting just uncomfortable. And I'm like, what is her problem? What's going on? And you could just feel this uncomfortable air in the room. And I was like, did you say retinal specialist? He said, no, I said rectal specialist. I said, brother, I got nothing to show you.
Yeah. We could all dial it down now.
I'm done. She was just like, oh my gosh.
Oh, thank goodness. Yes.
She thought I was about ready to show him. So I was like, no. So anyway, that was definitely my most embarrassing moment within the mortgage industry.
Outstanding.
I had this doctor, and his wife was probably ready to leave the room.
Yeah, that's way better than the worst client stories.
Yeah,
We wouldn't have gotten that out of a worst client story.
Yeah, no, not at all.
Well, I want to say thank you for taking the time to be here today. Again, this is Chris Norwood, Town Bank. You see him online. Look him up. Profile. He's everywhere on the internet. He is Coop to the Men's Alliance guys. We appreciate your taking the time to be here today. Thank you so much for sharing your wisdom and knowledge and years of experience with our team. And again, the goal is try to help guys shorten the learning curve while they're doing life.
Love it.
So thanks, man. Appreciate you.
Thank you, brother.